All right, welcome to our week in the price analysis class. What I have for you today is a set of notes. These notes relate to some economic lessons that are part of this idea of price analysis. So there are things that we want to start with. As we move into the futures market and trading and other areas, they're just lessons to consider as you move into the rest of this class. So we want to start with the basics for this week. They also continue from our work from last week, so make sure you take a look at those materials. But this week are 6 economic lessons that I want to focus on. So let's take a look at these notes. Follow along, write your own notes out. Okay, welcome to this lessons of this week, and we're talking about economic laws, things to consider. Really, these are factors that really reflect the market. So as we learn about these lessons, they may impact the way you look at trading in the marketplace. So these aren't all, gospel lessons. These are all economic concepts. So let's start with the first one. Here's the first lesson. It's not about dollars, it's about toys. The idea about value represents items over money. A good example might be a truck today. A truck costs $70,000 or more today, at least. And the answer would be why. Does the truck make us more money? Does the truck do anything like that? No, it's mostly related to these features: safety, value, comfort, power. They really relate to this concept of the toys. And that's what really drives a lot of economic decisions. So it's really the value of toys in the marketplace. There's a lot of examples of this, and one of them is something that we call balance of trade. In fact, it's a great example because this is a big discussion that we have today. A balance of trade is this idea of exports and imports. And the concept's given is that the more exports you have more than imports, then you're better off. And really the answer is no. A lot of examples that we have are with China, and that's one of the big struggles today. Exports to China are less than imports, and so really it's this idea of it's supposed to be bad, and in most cases, no. In most cases, it's fine because we value the toys. Now, that's a discussion today. Different countries import and export different values, but really it all goes back to toys, items that we can obtain, and really that's kind of when you get to a win in the market. So it may not always be about balance of trade, even though that gets talked about a lot. All right, let's move on to another area. Law of unintended consequences. We've talked a little bit about this. Automobile safety was our example. There's another example of this and how it might impact the market, and that's the Exxon Valdez. That was a tanker in Alaska that actually erupted tons, I should say, billions of gallons of oil, and it was affected negatively in the environment. So the U.S. government said, well, we can just have unlimited lawsuits. These companies can't be protected. Here's what happened. Now, oil companies use a third party to ship this. They have less risk. They've shifted it to the third party, and the intent was that oil companies should have more responsibility, but all they did was offshoot this to a third party, which really may create more issues. So sometimes risk in the market is addressed through, let's say, policy, and the oil companies were the example. The government allowed them to be sued for unlimited amounts of money, but really all that did was shift them to make a decision to use third party. Now, do we have more issues today with third party? And the answer is a big question mark. So sometimes intention doesn't always match what happens. All right, here's another rule. Another rule in economics is markets just work well. You have a supply and you have a demand in a marketplace, and y'all are all familiar with this idea. You have equilibrium. So consumers in the market will pay this much, and this is the quantity that will be delivered. Consumers benefit because they could have paid higher prices, but they didn't have to. Producers could have taken lower prices, but they didn't have to. So this idea of the markets work well. Now, there's things called externalities. They come into the marketplace like policy and regulations, and they alter what we call consumer and producer surplus. And so really there are situations where the markets work well, the law of one price relates, but externalities come in and they prevent the market from working well. So you look for that as you trade. All right, another economic lesson, number 4, is this idea of value. Value is really related to someone's willingness to pay. Sometimes we look at value at cost plus some kind of a markup. And really the answer is that's just not the way the markets look at value. Value is related to some other areas that we can't really define as much, but sometimes we call it worth or willingness to pay. And so an example of a market impact that's fairly recent is this value-added beef product, or you could even look at grass-fed beef as an example of this. that is alter the demand for beef over things that we used to consider to be gospel, like cattle on feed report or retained cows or number of cows out there, number of feedlot. Swift Foods is a large company, and they've even invested in this idea of grass-fed beef. So when we look at what value is in the marketplace, we have to start thinking about what used to be called strange is now what we call normal. Excuse me for that. All right. Okay, so that's another lesson, is willingness to pay. All right, let's talk about another area relates to value, and that's called opportunity cost. Opportunity cost is not a true accounting cost. It's really defined as the revenue given up when you choose one opportunity over another. A couple of examples of that may be a good one to look at that relates to all of you, and that's the cost of going to college. So when you look at the cost of going to college or making an economic decision, the cost of going to college sometimes is looked at as the straight direct cost. This is called an accounting cost, accounting profit. Sometimes it's looked at, that's what it really costs to go to school. Let's say it's $12,000 a year for our example. Number two is the idea of opportunity cost is another way to look at the value or the cost. And that is going to be that each year you could have gone out and got a job. You could have worked towards making your future, working on a career. Let's just say that if you did that, you gave up $24,000 a year. So then the question becomes, what is the real cost of going to college? And most people would point to that it is $24,000 a year. That's the way people make decisions. They don't look at exactly what it costs all the time. I mean, sometimes they do, but really economic cost is the opportunity. So time will kind of tell, but the revenue that you've given up, hopefully over time, by the time you graduate in college, your opportunities will go up from there. So maybe that is a great way for you to look at the value of going to college. Now that relates us to the last area, and that is time value of money. In a market, investments, back here at the cost of the career. So cost, here's an example, sorry, for feed. So as the corn cost, that's supposed to be corn cost, as corn cost goes up, that means less people will feed their horses because it costs a lot. The answer is no. Because they're looking at something, an opportunity cost. They're looking at some other value in the market and what they feel like that their animals are worth, which is hard to define. So, all right, let's move now to time value of money. Time value of money is this idea that investments are viewed, money is viewed over time. So when you look at changes in a market, you can't always think that they're going to happen right away. There is a time value that's factored in. So one decision relates to what you think is going to happen, but you see the opposite. And that is because, again, time is a factor in every decision in the marketplace. If we dive down deeper, time is really related to the time itself. So the more time you have, the less value it is today. It also relates to money. So the more money is today, the more the value may be because it's related to the dollars today. Or maybe there's a rate, like an opportunity cost rate. You could do something else with that money. Or it's actually an opportunity cost of a risk factor, or borrowing rates could actually impact decisions. So time value of money is another lesson that we can apply to our understanding price. So really, all of these lessons kind of relate to this idea that they would impact the market. And so as they impact the market, that means that these are lessons that you can use. Hopefully, as you get news on the market, or we learn through the semester as the markets change and you're trading, they're really things we should start off with. We should start off with that markets are based on facts, beliefs, values, and goals. And the facts are things that we easily learn right away, but these beliefs, values, and goals really relate to all of these economic lessons that we've gone over. So hopefully this helps you understand a little bit more about market